Good afternoon. Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, up on the screen on a Thursday, you can see mortgage-backed securities up a little bit, and over the last 24 to 36 hours, we're seeing a nice bounce. And so, in our Mortgage Market Guide weekly newsletter, we talk about this week about how the bond market is shrugging off higher inflation. We had a high CPI number this morning, matching the highest levels in 30 years, 5.4% year over year on the consumer price index, as well as the Fed minutes, which essentially laid out a timetable and a plan to taper bond purchases. So it looks like the Fed is going to start tapering either mid-November or mid-December, likely November, and they will start buying $5 billion less per month on the mortgage-backed security side and $10 billion less on the Treasury side, winding down both programs in the middle of 2020, which they said at the Fed meeting there was broad support to wrap up that bond buying. Now, the reality is the Fed is going to continue to buy bonds. They're just going to be buying less. And the Fed has been buying bonds for 13 years and probably not going to stop anytime soon. And what they will be buying is they have this gigantic portfolio of bonds as it gets paid off on refinances or purchase transactions. That money comes back in, they will put it right back into the bond market. Despite the Fed seeing the bond market seeing high inflation and the Fed probably going to wrap up, it's been in price discovery mode, trying to figure out where inflation is going to reside, where the economy is going to reside. And isn't it funny, right here over the last 2 days, we're finding a bottom exactly at the worst levels or the price bottoms of 2021. So from a pipeline management standpoint, it's pretty clear. Rates will stay at or better than current levels if we can remain above this bottom of 2021. And if we break beneath 99.50 here on this 2% coupon, we will likely immediately go and revisit rates last seen pre-pandemic, right, in January, February of 2020, which is a 3.5% mortgage rate. So we have a lot to follow over the next few weeks. We have the ongoing debates on the debt ceiling, which will reemerge. We have the Fed meeting. Obviously, that's going to be a big one in a couple of weeks. And we have the ongoing stimulus plan negotiations. And so a lot to track, but for right now, what we're watching here at Mortgage Market Guide and what you should be watching as a mortgage banker, how prices behave near these bottoms, because right now it is all about the charts and the bond market going through price discovery. Where will inflation reside? Where will the economy reside? And where does that 10-year note reside in a band? And that will probably help give direction to the stock markets. And this is very similar to what happened in early parts of this year when the Georgia runoff took place. Prices dropped. There was a discovery mode. We hit pretty much 175 in a 10-year note, which was 99.50 here, and we bounced off of it, and then we moved higher. Let's see if it happens again. Have yourself a great day and a great weekend, and we'll talk to you soon. Bye for now.